All right, today we are going to completely change how you see the buildings all around you. You know that office tower downtown, that shopping center on the corner? They're not just buildings, they're businesses. And we're about to demystify the whole world of commercial real estate, taking these big, complex ideas and turning them into a simple journey. So let's dive right in. First things first, we need a massive mindset shift. Residential real estate, buying a house, that's about finding a home. It's an asset you live in, an asset you consume. But commercial real estate, that's a whole different ballgame. It is an operating business, plain and simple. Its value has almost nothing to do with curb appeal or how cozy it feels. It's all about one thing, its power to generate income. So let's start right there with this new perspective. Commercial real estate, or CRE, is a business. It's not about the physical walls. It's all about the cash flow those walls can generate. So what is CRE officially? Well, it's pretty much any property used for business. And here's the key. Its value is tied directly to the income it pulls in from tenant leases. Think of it like this. The building is the machine, sure. But the leases? The leases are the fuel that makes the whole thing run. No fuel, no value. Okay, once you have that business mindset, an investor can start hunting for an opportunity. And it really is all about filtering, finding the right building by looking at its location, its quality or class, and of course, its potential. You've heard the old saying 1,000 times, right? Location, location, location. Well, it's a cliche for a reason. It is everything. You can renovate a building, you can find new tenants, you can refinance the debt, but you can never change its location. It is the one permanent factor that drives everything: tenant demand, rents, and the property's value over the long haul. Properties are also kind of broken down by quality into three main buckets. You've got your Class A buildings. These are the best of the best, brand new, shiny, in prime locations, attracting the top-tier tenants who pay top dollar. Then you have Class B. These are the workhorses of the market, a bit older, in good locations with solid, stable tenants. And finally, you have Class C properties. They're older, maybe in less desirable areas, and they compete mostly on price. An investor has to know exactly which sandbox they're playing in. Now, the last filter is what's called the highest and best use test. This is where you really start thinking like a pro. You have to ask, is this property actually living up to its full potential? First, is the use legally allowed? Is it physically possible to do it on the site? Is it financially going to work? And the big one, is it maximally productive? Is this the most profitable thing you could be doing with this piece of land? An old warehouse in the middle of a booming tech hub? It might fail this test. And that gap is exactly where savvy investors find incredible opportunities. Okay, so let's say we found a promising property. It's in a great location, it's the right class for our strategy. Now it's time to pop the hood and look at the engine that actually drives this business, the leases and the rent they bring in. And this is a really crucial distinction you have to get. Contract rent is the reality. It's what tenants are paying right now, based on leases they signed maybe years ago. Market rent, on the other hand, is the potential. It's what you could get for that exact same space if you leased it out today. That gap between the reality and the potential, that's where investors find either massive upside or a ton of hidden risk. Here, let me give you a quick example. Let's say a tenant is paying $25 a square foot on an old lease, but the going rate, the market rent, is now $32. Well, that means there's a 28% upside in income just sitting there, embedded in the property, waiting to be unlocked when that lease expires. That's called mark-to-market potential, and it's a huge, huge driver of value. But, not all rent is created equal. The structure of the lease itself really matters, because it determines who pays for all the operating expenses. In a gross lease, for instance, the landlord is on the hook for everything. But on the complete other end of the spectrum, you have a triple net lease. We call it NNN, where the tenant pays for pretty much everything: taxes, insurance, maintenance. And this choice, it dramatically changes the risk profile and the predictability of your cash flow. So, we understand the property, we've analyzed its income. Now, finally, our investor can answer the million-dollar question, sometimes literally, what's this thing actually worth? The starting point for any valuation is a number called net operating income, or NOI. Just think of it as the property's pure annual profit before you pay the mortgage or any income taxes. It's simple, really. You take all the potential rent you could collect, you subtract what you expect to lose from empty space or tenants not paying, then you subtract all the operating expenses, and boom, what's left is your NOI. And that NOI leads us to the single most important metric in commercial real estate, the capitalization rate, or just the cap rate.
It's simply the property's NOI divided by its price. The easiest way to think about it is this. It's the annual return you'd get if you bought the property with all cash, no loan. It's the fastest way to compare the pricing of different deals on an apples-to-apples basis.
Which, of course, leads to the most obvious question in the world. So what's a good cap rate? Well, the classic answer, as always, is it depends. It depends, because different property types have totally different levels of risk. And here's the rule of thumb. A lower cap rate means a higher price, which tells you that investors see it as a safer bet. That's why super stable apartment buildings often trade at really low cap rates, while something maybe riskier, like retail, might trade at much higher ones. The cap rate is just the market's shorthand for risk. So our investor has a target valuation in mind. Now it's time to assemble the team and actually get the deal done, because commercial real estate is definitely not a solo sport. I mean, just look at the whole ecosystem involved in one transaction. You've got the investor, sure, but you also have brokers finding the deal, lenders providing the money, the tenants who are the actual source of the income, managers running the property day to day, and attorneys papering the entire thing. It's a really complex dance with a lot of partners. And that brings us completely full circle, right back to the core philosophy, the big idea that underpins this entire industry. This quote just sums it all up perfectly. The entire game of commercial real estate exists in that gap, that tension between what a property is doing today and what it could be doing tomorrow. Closing that gap is where all the value is created. But misjudging it, well, that's where all the risk is.
So the next time you walk past an office building or a shopping center, I want you to try not to just see a building, see an operating business. And ask yourself, where is the hidden potential? And what is the hidden risk? Because that's the question that drives this entire industry.